Good morning, everyone, and welcome to Weekly Profit Talk. We do this every single week. We talk about the things that keep the profit of the private practice physician um, in their pockets and out of the hands of the IRS and other overheads. So, welcome. This week's topic is how to increase your take-home pay as a doctor without overworking. Now, this is a subject that should be near and dear to all because you can do all the right things. Make sure you have a good receivables process in place. Your collections, your patient registration, everything's up to date. But if you're not completely cognizant of the best possible way to elect your taxation, and yes, you do have a little bit of control over that. You could be costing yourself thousands of dollars, and it's not your fault. Nobody's basically mentoring people, and that's a gap that we're trying to fill here. So let me go ahead and I'm going to pop up my little special screens here. Okay, so you may be thinking, first of all, that this is some way of trying to increase your gross income by increasing or ramping up the patient encounters or working harder. It is not that at all. What we're talking about here is what I'd like to refer to as strategic income structuring. Now, what does that mean? The things that you do to basically help a patient or perhaps even save their life is something that takes a lot of experience as well as precision and timing. So, as I said before, the way that you are taxed can potentially put thousands of dollars back into your pocket, and you, as a result, take home more of your own money. So, you do have that choice, as I mentioned. So, first of all, it is quite likely, if you're watching this, that you have already elected to become an S corporation and you've been doing that for some time. If you have, that's great. At a certain level, and for most people, I'd say particularly under $10 million gross, S corporation is the way to go. What you're basically doing with your S corporation is you're creating a taxation that allows your net income to flow through to your 1040 after you have taken a reasonable compensation from your business. Now, doctors get hung up on this, and I see this all the time. You've done your 10 to 12 years of training and residency and everything, and you feel like a doctor's salary should be a certain minimal amount. At the very minimum, $120,000 or more. And that's certainly acceptable thinking. I mean, you earned it, you worked hard for it, you've got the the large student loan payments to prove it. But here's the thing: if your practice is slowly launching in the first couple 3 years, I would say in your maybe not infant but toddler stage, your practice may not be bringing in enough money to actually afford that salary. Despite the fact that you're able to take it. I have seen this where the physicians that own an S corporation actually take a salary that they believe is reasonable, and they're showing an actual net loss on their S corporation. And part of that overhead is driven by the salary they're taking. Now, here's what's happening. You are actually paying Social Security and Medicare on every dollar you take as a wage. The IRS does not believe that you have to take more wage than you absolutely have to. There's a phrase that you should get comfortable with. It's called reasonable compensation. And what this means simply is that if you're not making the money, they can't expect you to pay yourself that. They do say that you need to take a wage from your S corporation first, and this is true. So let's say, for example, you're in your first or second year, you're flying solo, maybe you've got a good office administrator and some sort of medical assistant. So you're running lean and mean on staff. At the end of the day, you're taking in $100,000 and you've been taking $120,000 in reasonable compensation. Well, you're basically presenting the IRS with an S corporation that has a $20,000 loss, and you're paying 14.13% on that $120,000 that you're taking as a wage and presenting that loss. This is not good. So 14.13. You're probably looking at about $16,000 in tax that you're paying out of your wage that you don't have to be. Here's what you do instead. If you reduce your wage to $48,000, which is reasonable, it's about half of the total net income that you're taking in. Yes, granted, I know that that's very low for a physician, but hear me out. The remaining $52,000 you now have as gain is your net income. It is yours to use as what is known as, believe it or not, the phrase is tax-free distribution. And what happens is now you're paying FICA tax on $48,000, a significantly lower salary. On that amount, you're probably right around $7,000 instead. So right there, you're dropping, what did I say, about $7,000 or $8,000 in tax. You are, as long as you don't take more money out of your business than you make in net income in a year, you're entitled to take distributions from it. They're called tax-free because the IRS's philosophy is that you're basically paying tax on the money as you earn it. Okay, so you're filing an S corporation return separate from your 1040, and you are paying tax on the amount that flows through to your 1040, but that tax on that remaining $52,000 is exclusive. No FICA tax. It's only ordinary income tax. That's where the savings in your S corporation come from. Now, that $52,000, you're entitled to every penny of it. I would suggest maybe taking 50 and build up a little tiny bit of additional equity each year, maybe $1,000 or $2,000 in your business. The reason for this is there is a flip side to S corporations. If you take more money out of your company than you earn in a year, there actually is the possibility of a separate tax. Simple to avoid. I don't want to go into why it happens or how evil the IRS is. We already know the answer to that. But remember, they work for the United States Congress, and I'll leave that at that. The main thing here is this. You are entitled to take the money out of the company that you earn, and you do not have to take it as wage. And that's how you increase your take-home pay. So I hope that this is helpful. And by the way, I do want to touch on one other thing. I mentioned in a previous slide that if you're not an S corporation, you've got another problem. Hopefully, if that's the case for you and you hung in there until the end, let me share some information with you. So if you're not an S corporation, and you'll know, that means that you've been providing your profit and loss information on Schedule C and attaching that to your 1040. You are paying both sides of Social Security and Medicare, the employer and the employee side. Look a little deeper into that tax return you have. There's going to be another form that Schedule C generates. It's called Schedule SE, and that just means self-employment. And you are paying on that $100,000, you'll find that there's $14,000 that you're paying in taxes. And the way to get around that is simply to elect to be an S corporation. There are ways to actually take you back in time, by the way, so that you can elect S corporation in the past, provided that you have either been a limited liability company or a corporation for that period of time. If you have questions about all this stuff, of course, that's what we're here for. We're coming to you live or on replay from any one of three different media. Of course, we're on LinkedIn and YouTube as well as Facebook. All three of those have a comment section. If you write into the comments, I need help, or how do I ask you a question, we are on there every single weekday, and even sometimes I see this stuff on weekends. So if you make a comment, or else you can write to Eric at owingsllc.com. And you can see the Owings LLC logo up there in the corner. Let me see if that gets bigger. No, it's the same size, but Eric at owingsllc.com, Eric with a C. And ask how we can be of help. We'll sit down. We'll have a initial free conversation with you, find out if we are in fact able to help you. But if you are still attaching your income statements to, by Schedule C to your Form 1040, let's talk because this is something I can help you with, and I can actually save you enough money to cover your accounting fees for uh, an extended period of time. So it's win-win for you. So let me know if, in fact, you have any questions about this, comments. Please give us a like and whatever if you enjoyed this. And we will be back next week. It's always on Wednesday, 8:30 Mountain Time. That is 7:30 on the West Coast, 10:30 on the East Coast. So until then, have an amazing day, the rest of your week. And if you do have a chance, do something randomly kind for a stranger today. So with that, so long, and we will see you next Wednesday with more weekly profit talk.